MarketChameleons and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need professional advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. If anybody out there, if you're new to the show, first time logging in and you want to ask a question, that's what this show's for, to ask questions. It could be Market Chameleon tools, data analytics, strategies. You saw something out there unusual and you want to share with the community, you're welcome to do that. Two ways to ask the questions is, one, you could type in your question on the live chat on YouTube. Will's watching it, he'll read it back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. Once you click on that link, it takes you over to Zoom. When you're in Zoom, there's a button, raise your hand. Click on that. It'll prompt you to turn on your video. You don't have to turn on your video camera, but once we let you in, everybody will be able to hear you. You could ask your question directly. While we're waiting for questions to queue up, we'll go over the pre-market report, and I think I'll take a look at a report out there that I don't reference that often. Maybe I should at least once a week, and that's looking at the straddle performance of how the straddles performed for individual stocks last week or going back longer than a week. And what we'll do today is take a look at indications, how the implied versus realized volatility did in the past week. We're going out further, and I'll show you some ways that people would potentially set up a dispersion strategy. And I'll get more into that once I bring up the report. It's kind of easier to explain it while you're seeing the numbers in front of you. But we'll start out with the pre-market report. If there are no questions, I'll go to that report, looking at the straddle performance. If you do have a question, let me know. I'll take those first.
Perfect.
Okay. So this is the pre-market report, and these are stocks trading in the pre-market hours. We have our most active stocks, our biggest percentage gainers, and our biggest percentage decliners. And I come down here, I see 95 stocks made our percentage gainers list, 36 stocks on the percentage decliners list. From this perspective, we're looking like a more bullish bias at the open. A couple things here. I think CPI numbers are coming out this week. That will give us an indication what's going on the inflation front. Are the moves so far that the Federal Reserve have done with interest rates, and with the bond buying, slowing down the bond buying, is it impacting, and where is it having the most impact? We have the elections tomorrow. Is that correct, Will?
That is correct.
And I think the market's sentiment is, if we get a divided government, if we get divided Congress, Senate, that could be positive for the markets, because it'll be harder to pass any type of new rules, regulations, initiatives, and no change is more certainty, right? Because if there's no change, then you already know what you're dealing with, and with more certainty, it's more positive for the markets, because now you could kind of plan around the given variables. That may be, and we'll see tomorrow, but a divided government may initially give a boost to the markets, or we're starting to get a little bit priced in now. So a couple of those things coming out. let me filter out this list to only S&P 500 companies. We're going to take out small cap stocks, ETFs, leverage products, closed-end funds. We'll remove all those and just focus on stocks that are in the S&P 500. To do that, I'm going to use this filter here in ETF, drop it down. I got a list of different ETFs to choose from. If you, let's say you select one of them, we'll do SPY. When you select it, SPY is the S&P 500 ETF. The list below will get filtered by stocks that are holdings in SPY. Here we see 9 stocks made our percentage gainers list, 4 net decliners. Again, from this perspective, slightly positive or bullish at the open. I do see Meta there. I think that now I'm hearing reports they're going to start laying off some of their workforce. You hearing that, Will?
Yeah,
Twitter laying off some of their workforce.
well, Twitter laid off, I think, 50% of their workforce at the end of last week. And actually, it turns out they laid off people that they need. So they're trying to bring it back, which is.
And they're trying to bring it back. Yeah. When you lay off that many people all at one time, then you're going to make mistakes. And probably some of those people are critical and they need them back. And you might not get them back, right? That's the risk.
I can't ever say I've heard of anything like this.
Yeah, those people might not want to go back. And you're taking that risk, because that's really quickly. He let go of 50% of the workforce in his. He didn't even have this. How long did he have control of the company? Not even a week.
Yeah. About a week.
I'm not sure how you could quickly make that assessment. Although I was reading, I think a lot of those jobs were like in India or outsourced, outside of the US. So I'm not sure if it's exactly like 50% here in the US. I think a lot of them had to do with jobs that were overseas. But we'll see. That's really quick, especially if you don't know the company that well. It's
a private company now, so you can't. There's really nothing one could do from a position standpoint in Twitter. But you wonder how this affects Tesla, in the sense that how much of his time is taken away from Tesla due to this. Right. And I've read that he has brought over a lot of Tesla people and SpaceX people to spend time, helping him turn around Twitter.
And are you stretching yourself thin? Right? He could be very talented, but are you stretching yourself thin? Especially, you're right that it's very different companies. You've got, and I don't think that, even though it's a tech, I guess there's a lot of technology involved in it. I don't think that this is something that, Elon Musk has dealt with before. It's a much different beast. And that's the social media space right now becoming, more, things are changing as far as privacy laws and different regulations coming down from different places in the world. And that digital ad space is very competitive. It's going to be a challenge, I think, for him. The Twitter might be a big challenge for him. I was watching an interview with him when he split up Tesla and SpaceX, and he made the decision: do I just let one go, or do I split them up and try to manage them both? And he admitted it's a big risk. I think so far it's worked out for him, but now he's got this other major, like beast on his hands. That's going to take up a lot of his time. Look, Jack Dorsey, right? We saw him going to Congress a lot, having to answer questions. You're put, you're going to be put under the microscope owning Twitter.
That you are.
Let's take a look at and what did he say? They're losing a substantial amount of money every day.
Yeah,
it goes like
and
$4 million a day.
Advertising revenue is drying up because people, are alarmed with the way he's operating in one weekend. It's just a lot of things, a lot of moving parts. And now he's going to try to charge Twitter users. I think the number's $8 a month.
Yeah,
it's interesting.
Yeah, it's interesting. We'll see how he handles it. So far, it's been choppy. Let's take a look at this report. And go under options, straddle, and wing backtest. Now, what this report is doing is tracking options for individual stocks. So here, we've got Apple, Microsoft, looking at if you did an options trade at the beginning of the week, Monday, we take a snapshot Monday at 10 a.m. We give the first half hour the markets to kind of trade and tighten up so that the bid-ask spreads start coming in a little bit. We take a snapshot of the options at 10 a.m. on Monday, and then we track them to see how they perform by the end of the week. So we give them an entire week's time span, and then we track that performance, and we do that week after week after week. Okay, and right now it's defaulted to the last 12 weeks of observations. You could change that, but let's keep it here for now, because I'm going to use some of these filters after I explain what this report's doing. The tracking looks at the options from three different perspectives. One is it looks at the money straddle. If 10 a.m. looks at which strike, looks at the very near term options that has at least a week to go. And it looks at the strikes that are the closest to at the money, takes a snapshot of the call and the put, right? That's a straddle. You're buying the call, you're buying the put on the same strike, or you're selling the call and selling the put at the same strike. Takes a snapshot at 10 a.m., tracks it to Friday close. So if it could expire that Friday, if it's a weekly, it'll expire that Friday, and basically it's parity. Or some stocks don't have weeklies, they'll have monthlies, so it'll just track to whatever the option is marked to market at Friday's close. All right, and let's look at just the at the money straddle here, because we have three different. We have an out of the money call, out of the money put, at the money straddle. So I'm going to just look at the at the money straddle right now. So this call and the put, and then there are three different ways you could trade that straddle. One is you could just put the straddle on Monday and hold it all the way to Friday. So do absolutely nothing in between. Monday 10 a.m. I bought the straddle, and I don't care what the stock market does. Friday it is enough time for it to move, and I'll give that entire week of volatility, and then at Friday I'll see what happens. So it's basically betting like an over under move. And then another way to trade it, right, is to make it delta neutral. So straddle is not exactly, it's hard to find usually a straddle or a strike that's exactly the same price of the stock, right? So sometimes you'll have, a strike of 50, but the stock is $49, or the stock could be $52. That means that it's not really a perfect straddle. It has a delta to it. Basically, it's in the money it could be in the money. The call could be a little bit in the money, or the put could be a little bit in the money, then the opposite's out. So to offset that, you can hedge it by doing stock to offset that delta. That's the delta neutral. And then if you use the Black-Scholes model, that's when every day the stock could move, right? So you have Monday through Friday. So Monday by the end of the day, you put on the straddle at 10 a.m., but by the close, the stock could move. And if the stock moves up, that means your call's worth more, your put's worth less. If the stock moves down, your put is worth more, your call is worth less. And to kind of lock in some of those gains, on the Black-Scholes model, you would hedge your delta, right? So if the stock goes up and your call is worth more, your put is worth less, you have this delta risk. So you would sell short stock to offset the delta. If the stock goes down, all of a sudden your put is worth more, but your call is worth less. To lock in some of that gain on a put, you buy stock to offset your short delta. And the next day the stock moves, and again, you have the same thing. It could swing back and forth. And what you're doing is hedging your delta using the stock. And in effect, you're trading your realized volatility, the stock volatility, by hedging, right? So when you're hedging with stock, you're trading the realized volatility. You're buying stock when it goes down, it goes up, you're selling it back out, it goes up higher, you're shorting it, it goes back down, you're buying it, you're trading the realized volatility against your implied volatility, which are the options. All right, so the options have an implied volatility, and based on that, they're going to decay, between now and its expiration. So let's take a look at first the hedging. So these are daily rehedging, okay? And I'm going to look at it just last week. So the most recent week. This is the most recent week and how these options perform. Now, right now, they are sorted by the highest market cap. Apple, Microsoft, Google, Amazon, Tesla, and so forth. These are all sorted by highest market cap. And we could see here in Apple last week, right? It's only one observation last week. If you did the hedging strategy, bought the straddle, rehedged daily up until Friday, the return on the amount at risk was 19%. So imagine if you bought a straddle worth $1,000 worth, right? You took $1,000 worth of risk and bought a straddle, the return would have been $190. $1,000 plus your back plus $190, right? 19%. Microsoft return was 9%, Google 37%, Amazon 40%, Tesla 2%. Then you got Berkshire break even, UNH, XOM, as you could see. And just to kind of show you how a strategy could also work, you could obviously look at these individuals and think that the straddle may be underpriced or overpriced, and you could do your analysis. But there's another thing, it's called a dispersion strategy. Hopefully, and I'm just introducing you guys to different ideas. It's up to you to go really read it and set up the models. But as you could see here, look, the top, 1, 2, let's see, this is Google, 3, 4. These all were profitable. But how would you offset some of that risk? And the dispersion strategy would work where you think that maybe a group of stocks that belong to a certain index, let's say here the S&P 500, are maybe the straddles are underpriced versus what the index is priced, let's say SPY. So here's SPY right here, SPY. So you could see here SPY lost 9%. And the idea is, well, if I buy straddles in SPY in stocks that make up maybe, now here, I don't know, Apple probably makes up 7% right now of SPY, something like that. Top, maybe this is not enough. Maybe it's 10%. You'd have to figure it out. I don't know off the top of my head. We could go look. But the idea is, well, if I buy those straddles, and I'm betting on those moving, but how do I offset that risk if the market just sits there and they all sit there? Well, I could sell straddles in the index, right? SPY, because selling straddles in SPY is a little bit less risky than selling a straddle in an individual stock. And that's because SPY is already diversified. SPY chances of going bankrupt to zero are, almost very small. We've never seen the entire, S&P 500 just go bankrupt and all the stocks simultaneously go to zero. In an individual stock,
I wouldn't think it could happen until what happened in Russia.
Yeah. So, but essentially, that's the idea, right? That there's less, somewhat less risk in the S&P 500 selling straddle than you are if you just sold it like in Apple or Microsoft. And it could go the other way too. There's less risk that there's a big shock to the upside in the S&P 500 there's much greater shock to the upside in an individual stock because it could get taken over, something could happen, right? So like Twitter, somebody took over Twitter, nobody knew, but all of a sudden you're like up 30-40%, right? So having the entire market go up 30-40% is unlikely, right? If you're selling that straddle, to see a shock like that, all of a sudden is unlikely. So the idea is, the dispersion is, well, if I'm selling premium in the indexes versus buying premium in the individual components, and it's not reasonable to buy all 500 stocks. You would have to buy some basket that is closely correlated to the SPY. And sometimes people do it just with a few. But the idea is, I am basically trading realized volatility and implied volatility, but I'm also hedging off that market risk volatility. And we could see that in front of us right now. Last week, it would have worked beautifully because not only did you make in all of these, if we just use this as our example, this top group, but you also made on the SPY because the SPY actually lost. So in this situation, that dispersion worked beautifully for you because each side of those legs work. Now, sometimes it doesn't have to work out that way. You could still lose on the hedge in the SPY as long as you're offsetting those here, right? So as long as these are on average making more than what you're losing there, that's fine too. But the idea is they have to kind of first line up probably to be favorable. And by doing that, you are hedging off some of that risk, because if the market just sits there, obviously, and everything sits there, these will be down. And if these are down, and SPY is down, you're offsetting some of that premium loss, and the other way around. Does that make sense to people?
Seems to, no questions.
Okay. And I'm showing you guys this because we had a question, Lauren had a question last week, looking at the implied volatility of an option. And a lot of times, how do people decide if the implied volatility of the option is high or low? And a common metric is to compare it to itself, compare it to its historical averages or historical observations. What is implied volatility 50 high? Well, I don't know. But for this particular stock, if you look at historical observations, it might seem high or it might seem low. And you have to figure out, is that justified? So it's just giving you a metric, but you have to figure out if it's justified. But that's not the only way that we could value or measure how high or low it is, because if a stock's movements are sensitive to the market movements like we have right now, a lot of stocks are now becoming very sensitive to the overall movement of the market, then we could start looking a little bit further into it and saying, well, maybe the historical implied volatility of Apple is no longer as relevant to the implied volatility today, because Apple's movements are being driven by the market, and the market is volatile, right? The market is volatile because interest rates are on the rise. We still don't have a clear indication when this, when will we reach peak rates, what earnings will look like in the future. There are a lot of uncertainties. And now we could, given those circumstances, then you could take a look at it from a different perspective and say, well, how high is implied volatility of Apple relative to SPY implied volatility? Because implied volatility, what is it? It's a forecast of future volatility in the underlying, right? That's what it's forecasting. This is what the market thinks the future volatility of the underlying to be between now and that expiration. And we could compare that implied volatility to an individual stock, and doesn't make sense. So maybe even if Apple implied volatility seems high versus historical, it might not be high relative to where the market is pricing it, right? Where the market's implied volatility is right now being priced. So on a relative basis, we could look at it from 2 points: from its historical volatility, or where is SPY right now, right? So where is SPY right now? And we could see here that I'm going to look at these benchmarks. So here's a straddle. So we could see here in the next 30 days, the straddle is implying a move of 5.5%. So this is just the movement. It's not looking at implied volatility now, just the movement from now to, that's if you don't hedge, right? 5.5%. We could see that is above its 52-week average right here. Not at its high, but above the 52-week average. That's how it is. And we could compare the same thing. Well, what about Apple? It's at 8.2% or 7.2. So that's kind of how the 30-day straddle you could compare are being priced against each other. Implied volatility would be different. Let's take a look at the implied vol. So this is the implied vol of Apple. And I want to, before I compare this to SPY, notice that these E's represent earnings. And those earnings, the implied volatility, you would have to remove those from this analysis because you need to clean the data. Earnings, the stock is not moving because of its sensitivity to the market. That's moving to its firm specific news. So if you are creating this model of Apple versus SPY, let's say, you'd have to clean out the data to make sure that you're removing observations that are specific to Apple and are not based on, its movement to the overall market. Okay. And let's just take a look at, this is SPY. And we could see here that, there are instances where there's a big, they diverge and then they come in. So you would look at the big divergence, right? So there are instances where this is too close together. This was too wide, right? That's the idea behind dispersion. You're spreading out the risks. Okay. We're right up at 9:30. I guess there are no questions today, Will. I'm going to leave it at that.
Nope. Great job, D. Thanks so much.
All right.
Actually, reminder, we have a webinar tomorrow, interactive broker webinar. What is the title of it again?
2
Stock volume
o'clock.
profile?
Yeah, we're going to look at a volume profile of a stock, or stock equities.
All right. I'll put that link in the chat. Thanks for job. Thanks
All
so
right,
much, my friend.
everyone. Thanks for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Trade in peace, chameleons. Thanks, Steve.